Let's switch it over to currencies now because the pound extending Friday's 8% plunge as investors continue to react to Britain's vote to leave the European Union. Jane Foley, senior currency analyst at Rabobank, joining us now from London. Jane, thank you for joining us. You know, we have seen calls that the pound could go to parity with the U.S. dollar. Your thoughts? Can it go that low?
Well, if we go back a month or so ago, my forecast on a Brexit was that we could go down to around about 126, which at that point was a 15% move. Now, to me, parity still looks a long way off. I mean, that would be an extremely big call. What we were looking at on Friday was an 8% drop. It was 11% off at the lows. We're still not back at those lows, but I think, you know, sterling can go lower in the next few days, in the next few weeks. If we look back at over the last 30 years, the big movements that we've had in sterling driven by politics, it hasn't been a one-day move or two-day move. These things have happened over time. Now, uncertainty, we know, is a big negative for a currency. And right now, we've got the leading government party in complete disarray. We have the opposition party in complete disarray. We've got very delicate negotiations that now face with them over the next few years to take us out of the EU, and yet we have no leader to actually take us through that delicate procedure.
Jane, I wanted to ask you about the other currencies, particularly U.S. dollar. Always is going to be my #1 question because that's where we are right here at home. But any other currency in addition to the U.S. dollar that matters to us here at home on the movements that we're seeing? We know that the pound is over 30-year lows. Anything else that you would chime in on?
Well, of course, if we think about what currency investors do, they move into safe haven. Now, who are the safe havens? Well, there's the Japanese yen, there's the Swiss franc, and then there's the U.S. dollar. Now, if investors do move back into the U.S. Dollar, that's not going to be great for inflation in the U.S. It will slow down the rate of inflation. Therefore, it has implications for the Federal Reserve. But perhaps more importantly, in this environment, it could put pressure on the Chinese to devalue their currency. So we see that there is the possibility that we get this knee-jerk reaction, this domino effect that could really impact the whole of the global economy.
Jane, do you expect to see intervention from some of the central banks around the world?
Well, there's been lots of pressure from the U.S. Treasury on the Japanese in recent months not to intervene. The usual mantra of the G7 is that markets should be setting exchange rates, not governments. So there is this pressure not to do it. But the Japanese, of course, they went in 2011. They intervened after the tsunami, after that awful earthquake, and that was acceptable. Now, you have to ask, is the sort of volatility that we're seeing today, would that be acceptable? And I think at the moment, no. But if we carry on getting huge movements in currencies over the next few weeks, the likelihood of intervention does increase.
Okay. Jane Foley, thank you very much, senior currency analyst at Rabobank. Thank you.
Thanks, Jane. We'll come